What's up, my friends? It's Downtown Josh Brown. I'm here with Michael Batnick, as usual. We are here to play our favorite game, What Are Your Thoughts? As we do every Tuesday. Michael has no idea what I'm going to ask him about, and I don't know what he wants to ask me about. Play along in the comments below. We love your feedback and pithy remarks. Let's get right into it right after the break. All right, Michael, great to see you as always. I like your headphones. Are you ready to land a plane of some sort, or can't find the AirPods? What's the story?
Just changing it up.
Changing it up. All right, change is good. I wanted to ask you about the post that you wrote about most stocks suck, and the thing that jumped out at me. This is your quote, basically saying that most stocks do worse than the stock market. If you were throwing darts at the S&P 500 over the last year, you were 8 times more likely to hit a stock with a max decline of over 60% than you were to hit a stock with a max decline of less than 20%. And for context, the market only declined in total by 33%. So most stocks did way worse than the overall market. I think we understand some of the dynamics behind why that's the case, given how large the large stocks are. But was that surprising to you in the course of your research?
Not necessarily. I mean, what I said was that this is not unique. The fact that most stocks are underperforming the benchmark. I think it's usually 2/3 of the time. I'm sorry, 2/3 of all stocks underperform the index. And I saw an interesting stat recently.
Over 2/3 of all stocks underperform the index on an annual basis?
On an annual basis, I believe.
Right, okay.
I saw an interesting stat from Invesco showing that the likelihood of outperforming if you're just buying and holding a random stock actually decreases with time. So there's like a 49% chance of underperforming over 1 year. And that drops over 3 years, over 5 years, which makes sense.
Is that skewed by the fact that a lot of stocks just disappear, either because they get acquired or they go bankrupt? Does that have something to do with why the longer you hold a stock, the more likely that stock is to underperform? So
it's that, and it's the opposite. It's that the crappy stocks aren't represented in the index the way that the big winners are. So you have both things going on. So anyway, I was able to pull up this max decline or this max drawdown very easily on Y charts, and basically I was able to show that this part shocked me. Only 10 stocks had a maximum decline of less than 20%.
Only how many?
10. Only 10 over the past year.
10 stocks in the S&P 500.
Only 10 stocks. Costco, Walmart, Clorox, Hormel Foods, Dollar General, Verizon, Eli Lilly, Vertex, Norton, LifeLock, and Citrix.
These things were like rocks. Just an absolute rock. Unbelievable if you were in those names.
Now, I guess this is also skewed by the fact that what are the stocks that fell 70, 80%? It was the names that were directly in the eye of the storm. The energy companies, I don't know if any airlines fell 80%, but it was the junk for sure.
So now you say to yourself, the allure of stock picking is that, forget about just this year alone, is that you're going to end up in an Nvidia or an Apple, and you're never going to sell it, and you're going to eat all the declines. And that works out really great, of course, in hindsight, but think about how many stocks you held individually, which I guess if you did that alongside an index portfolio, right, which is what I've always done, think about how many of those stocks don't become Nvidia, don't become Apple, and you look over 10 years, and yeah, you've done okay, but they just didn't keep pace with the index. That's the experience that you would have had with what percentage of stocks? 2/3?
So the 2/3 number that I'm recalling is for the S&P 500. I believe that's roughly it. The 49% was looking at the MSCI All Country World Index.
Okay. So it's not an anti-stock picking or a pro-stock picking argument. I think it's just a good idea to set your expectations.
It's a pro-risk management argument that most stocks suck and never come back. Like a lot of these stocks have declines to where they never recover. So if you know that in advance, then maybe have some sort of sell discipline. Like don't hold a stock that's going to fall 70%, to state the obvious.
Okay. I love it. What do you got?
All right, sticking with that, the tech stuff. Some of these data points are just insane. This is from Nate Rossi via Barron's. Option volume in single stocks averaged a record 18.4 million contracts a day in August, which was up 80% from the average monthly vol in September. Sorry, in 2019. In September, it's already 24 million. and this was probably last week. So it has gone absolutely bananas. There was a ridiculous survey showing that 43% of all traders are using leverage, which, I mean, obviously that's not true. But here is a crazy chart showing the fund flows for the Qs versus TQQQ. And TQQQ is the triple lever version of this of the NASDAQ 100. So
the triple Qs. Oh my God.
So last week during the decline, there was a pretty hefty outflow from the Qs, not surprisingly.
Okay.
Look at the flows into the triple Qs. Aggressive. Okay. So money is rushing out of the Qs and rushing into the triple Qs, the levered version.
Okay. Oh, that's outrageous. It's a caricature of a bubble.
I mean, literally. So here's one more thing. Bank of America, Merrill Lynch put out a survey this morning, the evolution of global fund manager survey, the most crowded trade. And
right.
Not surprisingly, U.S. tech and growth was the number one. I think 59% of managers were long previously, and now it's up to 80%. So it's safe to say that expectations in the space are fairly high.
You know, so Al Michaels is like a major
Al Michaels
CNBC
did not see this coming. Al
Michaels, who's the host of I guess Sunday Night Football for NBC, one of the greatest sports commentators of all time. I've met him throughout the years. He's come on the show. I went out to the Super Bowl and we did some CNBC with him, and he's like an avid trader. And every time he sees me, he tells me what his positions are. He's in all of these triple leverage, and I keep going, dude. Those things are f***ed up. Like they have negative leverage when they go down, and they reset each day. He's like, Josh, all I do is make money. He's like, I hear you, and I appreciate those words of caution, but I'm triple long tech, I'm triple long NASDAQ, whatever, and I keep making money. So what do you want me to tell you?
Al Michaels uses leverage?
Al Michaels uses triple ETFs, and he loves them. He loves them. Will not part with them.
Wait, hold on. Hold on. Before you go in, one more stat from Sentiment Trader.
Okay.
Last week, so people are like, well, when you see this option data, you don't really know if they're buying to open or like it's very murky. He said to Balchunas, they were having a chat last week, over 60% of volume was under 11 contracts. 50% of that was buying calls to open, and the premiums were 2x all prior extremes over the last 20 years. So it's safe to say that humans are behind it.
Okay, yeah, clearly. And this dovetails with a journal article that I put on blast this week about how you think about options as a percentage of the stock market, right? So 3 years ago, the amount of options contracts traded was only 40% of the total volume of stocks traded. And in August, it broke a record. It hit 120%.
So look at this chart. Same exact thing you're talking about.
Right. So now, so you say to yourself, like, let me get this straight. More people are trading, or not more people. People are trading more options contracts on single stocks than they're trading the stocks themselves. It's not that that's automatically a negative, but it's definitely a sign that gambling is more prevalent than investing right now. And you don't need a stock market crash to wipe that out, because I know it's a lot more calls than puts. It's a lot more bullish bets than bearish bets. Fine. But it's probably not massive dollar amounts. And people just saying, look,
not true.
I have
not true.
Well, hold on. If I have $3,000 and I want to buy Fastly going into the earnings, like, am I going to buy 10 shares of Fastly, or am I going to give myself the upside of that earnings trade using options? And I understand if I'm buying calls, out of the money calls, and I don't have a long window until expiration, it's like an all or nothing bet, but it's $3,000.
Yeah. Okay. That makes sense. That makes total sense. However, I think Sentiment Trader said that retail activity was $40 billion worth of premium bought. 40 billion. That's a ton.
So it won't all get wiped out, but quite a bit of it will.
Well, also, if premiums are 2x what they used to be, then you probably hit the buy button and you're like, you see that you're already down 15%. You're like, wait, what the hell's going on?
Okay. Do we think that this is affecting valuations in the tech stocks involved long term or just on a day-to-day basis? Like, do we really think that there are stocks that are worth more than they should be strictly because of how much options activity is taking place? I really don't buy that argument, but I know a lot of people think it's real.
I definitely think there's an element of that. Just look at Apple's valuation we spoke about a few weeks ago.
And you think options trades?
It's not just options. It's hard to separate this. It's hard to untangle the web. I think that there's a lot of feedback going on. But yeah, I do think that like previously I would have said no, that's ridiculous. But now it's so pervasive that I do think there's some of that going on.
Okay, I want to switch gears here. We got to talk about this Nikola thing.
I'm not following.
All right. Well, let me set the stage. Basically, this is a company that came public as more of a business plan than an actual business. And the idea was they were going to build fuel cell propelled trucks, like semi-truck, big, not like pickup trucks, but like real, like 18-wheelers.
Without gasoline.
Semi-trucks. And right, so it's hydrogen fuel cells, which is like a 30-year-old technology that for whatever reason, no one's actually been able to figure out how to get these things onto the road. But if you could, you're basically fueling the truck with water. It's like it would be the plot in a James Bond movie that like somebody wants to topple the oil market by inventing water-propelled trucks. Fine, whatever it is. So he comes public via SPAC, which you know for me is always a red flag. I'm not saying they're all scams. I'm just saying like most of them are. He's this guy, Trevor Milton, extraordinarily promotional, like very much like trying to be the next Elon Musk. And even the name of it seems scammy. So Tesla's last name was taken, so they use his first name, Nikola. It's like, what if a third company comes along? What was Nikola Tesla's middle name? Seymour? So, all right, that's the name of my company. So it all seems like bullshit to me. I did a podcast about SPACs, and what I was saying about Nikola is like, if Tesla didn't exist, would this be a public company? No fucking way. Of course not. Not a chance. But they actually managed to get like this huge deal with GM. I think they gave GM $2 billion worth of stock, and they're hired GM to actually build the trucks because they clearly don't have the ability to build this stuff themselves. Now you have this short seller, activist short seller, Hindenburg Research, which, I mean, the guy does incredibly in-depth work, basically came out and said this is a fraud, laid out all these points why, and I just want you to react to this. The number one point that resonated with me, and I don't do forensic, deep dives into stocks, but
you do memes.
They put out this promotional video of the truck itself, but it doesn't actually work. They push the truck down a big hill. So there's a video of the Nikola hydrogen fuel cell semi-truck rolling down the street, and the short seller's like, guys, we know the truck is not moving under its own propulsion. You pushed it down a hill for the video, and the CEO refuted this whole report, but he didn't refute that. He's like, no, the truck doesn't work.
It sounds like a parody, like something you would see on SNL, finance version.
Do you understand that Mary Barra at GM committed to a massive production deal?
I thought they backed out.
No, they didn't back out. But one of the things that Hindenburg is saying, which is true, is that GM is not taking huge financial risk here. They were like given shares, it's called an investment, but basically they're getting work from this company. This company's like, rather than us build our own hydrogen fuel cells, GMs are better. So we're going to just put the Nikola skin over a GM truck. So it's actually
GM conducted appropriate diligence on $2 billion Nikola deal. CEO Mary Barra says, okay, that's my forensic accounting. I'm sold.
Well, the stock went up 40% on that news, and it's since lost almost all of that.
It's down 7% pre-market.
And it was down, I think, 30% at the end of last week after the short seller
What's the market
put out
cap
the report.
Of this thing? $2 trillion?
90 trillion. So now the SEC is going to investigate from both ends.
$12.5 billion.
Right. So now the company went to the SEC and said, this guy's manipulating our stock price. The short seller is like, I'd love to talk to the SEC. So now if you're a shareholder in this disaster situation, you have to, like, I guess, sit there and wait. But here's what I was thinking. And Bethany Frankel touched on this when she was talking about Tesla. So Hindenburg says this company's a fraud. But I've always looked at this kind of stuff as like a Schrodinger's cat situation, where like the philosophical concept where you put the cat in the box, you close up the box, is the cat dead or alive? Well, we really don't know unless we open the box. So it's both dead and alive, right? Until you open the box and see. If this guy Trevor Milton can raise money continually, he might get to the point where he has a fuel cell truck.
Yeah, but
so yes, it's true that he's making these outrageous claims that aren't backed up, and that's probably not legal, but it doesn't mean that this company can't continue until they get to the point. And the best example of that is what Tesla's done over 10 years. They fake it until they make it.
But look at this revenue
and now
growth.
they make it.
Look at this revenue
What's that?
growth. Look at this revenue growth.
Oh, yeah. Startling. They went from a penny to 2 pennies in sales. It's terrific. Look, I would just say, my last thing on this, the reason why the CEO has to fight back and can't just be like, we know we have a real product, say whatever you want, is because this whole business model is based on belief. If they can't raise money, continually raise money from investors, there's no chance they'll ever build a truck. So he actually has to keep the stock price elevated in the way that Tesla was able to do to have a product. So I hate belief-based business models. And here's the last question that I would put to you is like, if you're buying these types of stocks, you almost have to accept the fact that there are going to be skeptics that come along and just light them up periodically, and you have to swallow that volatility, no?
If you're a believer, yeah, that's the game.
It's part of what goes along with it.
All
okay.
right,
What do you got?
Let's talk about the reopening. Last week, Carl Quintanilla tweeted this chart about the reopening. I don't know who this is from. Goldman. Oh, it's from Goldman. In week 19 of the Measuring the Reopening of America series, we shift from a 4 to a 5 after several weeks of little to no improvement, as lodging, retail, and box office all show meaningful progress over Labor Day weekend. So you see this chart, it was plateauing, and then boom, a breakout.
What are the inputs in this chart?
I don't know exactly.
Okay. It looks like a rainbow cookie.
Well, it's measuring the reopening. You don't need to know the details. Tell me.
Well, I'm just curious.
Credit card. Credit card. I'm guessing other shit.
All right. So basically, they're saying the economy is 72% reopened. That seems right to me. I mean, I'm just based on what I see with my own eyes in real life. I don't know. Is that a way to? So how should we think about this? Like the further this goes, the further this goes into the green, the more we want to own stocks that are associated with a reopening economy. I would buy that.
Yeah, I think so. Hotel.
I'm in Shake Shack personally. This is the worst company in the sector for the pandemic economy.
Looks good.
They have almost no drive-throughs. I got lit up in this stock. It was like $100 and it went to 30. Now it's 70. So there's no way that stock is working unless this chart that you're showing me about the reopening is somewhat accurate, because they can't survive on app delivery. It's just not, the company's not built. It has no drive-throughs. They're just not built for that. So I think Starbucks is similar. Starbucks got decimated in the pandemic because of how important business commuters are, how important travel is. You know, all their stores in airports and in tourist destinations. So those stocks are now percolating. So I guess I would buy this.
They're looking a lot better. So are the casinos, the cruises, airlines.
I think it's fair to say that most stuff has reopened in a modified way, and it's just probably not as good. The Wall Street Journal does a podcast. They call it The Journal. It's actually pretty good. The episodes are 15 minutes, which I fucking love. They interviewed this woman who owns 7 Irish bars in Chicago, and she's like, 6 of my 7 bars are open. One of them just doesn't make sense to reopen based on where it's located. And she's like, normally I would have 350 employees working. I have 130 employees, and it is what it is. We're open for business. So so it's like there's just a percentage that's just not going to open until we're fully reopened, no matter what. And I think that applies to a lot of businesses on Main Street. I want to ask you about the NFL. Did you sit in front of Red Zone on Sunday?
I did.
Did you watch any games?
I did.
Do you miss the audience?
No, I thought it was pretty effective because when you're watching football, aside from like the punts, really, and I guess Hail Marys, you don't really see the crowd anyway. And
They're
I
shooting
think
level at the field.
yeah, so I think they're going to figure out the crowd noise was a bit awkward that they were pumping in, but I think that they're going to get there. I thought it worked really well.
I was thinking instead of crowd noise, what about like a laugh track? Or when the Giants are playing,
When the running back on the line just dropped the ball at the end of the game, if they put a laugh track over it.
yeah, I was watching the Giant game. I was watching the Giant game last night. I was supposed to watch it with my son. That was like the big thing we were waiting for, and he's in 3 different fantasy football leagues at this point. He played Fortnite instead. He's just I was very weirded out, so I watched it by myself. I don't know. It was good. It was good to see the games back. I didn't love the crowd noise, but I'm okay that they're doing it. I get why they're doing it. It's interesting that some stadiums have no crowd at all, and then if you watch KC play, they got 17,000 people into the stands.
And I think the Jags too. I don't know how that works.
Maybe the states in the South and the Midwest don't care as much, and the coastal states are still petrified. I don't know. I think it's good that it's back. And I said this about baseball. I do think the real economy is watching football. And I think if they have an outbreak and they just plow through, it's another good sign that we're capable of doing that now rather than just closing everything down again. So I think this is just like one more example of that. So I was happy to see it. You got anything else?
Yesterday, Darren Ravel tweeted, New Jersey sports betting handle for August is $668 million, breaking the all-time state monthly sports betting handle record by $70 million, which was Nevada in March 2019.
Okay, breaking the record doesn't seem that impressive because a lot of this stuff is legal for the first time.
True, but it was a huge number.
How do you square these massive numbers of...
And by the way, hold on. August was really just basketball and who bets on baseball? Real junkies.
Well, it was playoff basketball. How do you square these massive numbers for sports betting with the fact that the ratings for sports are just not that great?
That's a good point.
Maybe it's just the hardcore people watching and they would bet anyway.
Anyway, the numbers in September are going to demolish August.
Because now it's football.
That's what I'm saying. All right.
And college football. Okay.
There is backlash going on in the remote work stuff. There's people who can work remotely, or people that have to go to the office getting pissed off at the people that can be remote. There's people without children that are pissed at parents that are getting special accommodations. Bloomberg had a chart showing the Americans with higher incomes or more likely to telework in August. If you made less than 25 grand, you're going to work. There's a 90% chance that you're going to work. If you make 200 grand or above, there was only a 30% chance that you were going to work in August.
Yeah. This is like a continuation of something that's been happening for a long time, which is that the knowledge economy is very much its own world. And if you were pissed off about income inequality and wealth inequality before the pandemic,
this is gasoline.
You're really going to hate what the other side of this, or I guess the current side of this.
Well, I was going to say we're still in it. I'm curious to see what happens when the economy is fully reopened and people are still like, "Nah, I'm good staying home," and companies are like, "Well, no, get your ass back to work." So that's going to be very messy. And I don't think there's a playbook yet for that.
I have 2 friends who work on Wall Street, and one of them's in a sales role, the other one's in a trader role, and they're both being pressured to start a plan to start reporting back, but they're not being told officially, we expect you back, but they're starting to hear that chirping. And the problem is, like everyone that lives on Long Island, there's no real way to get into Manhattan other than the train on a reliable basis, unless you want to get on the road at 5 o'clock in the morning and spend $100 a day in parking. So they're not getting on the train, and they're just like, the guy telling me he wants me back is himself not coming in. So I don't know how soon people are reporting back. In a personal anecdote, I have surrendered. I now have office space, as you know, in the town next to mine, because I can't imagine being on the Long Island Railroad. And by the way, even if I went into the city to do what? Sit by myself in a room with a mask on? Nobody wants to hang out with me. There's no meetings. There's no events for me to attend. So I don't think the backlash is going to really do anything. I think we're going to be status quo like this for a while.
Wait, what do you mean it's not going to do anything?
It's not going to force anyone to do anything that they're not already doing. People are not going in to their offices.
But what if companies leave those people behind? They say, okay, you don't want to come in? That's fine. Work somewhere else.
That could be, but I don't think there's any evidence that it's happening yet.
No. When the economy reopens, that will happen.
What does reopen look like? What if companies decide, you know what? This is great. We don't have to provide space for 50 people. We could have 25 people come in a few days a week, and the other 25 come in a few days a week, and we save on electricity, don't kid yourself. It all comes down to money in the end.
So there will be roles that don't have to report back to the office. I'm guessing probably senior roles and roles that do have to go, maybe lower level people, and that is just going to plant the seeds for resentment. I think. I don't think that this is going away.
I definitely, before the pandemic, I had a bunch of friends who had jobs where they never had to show up anywhere. A lot of them were sales jobs, like pharmaceutical stuff. Like they had their territory, who they had to go see, and they never had to like commute on the train 5 days a week like I was doing.
Yeah, that's that role.
I definitely hated their guts.
And I think that young people specifically are disadvantaged if they can't be in the office and showing their boss what they're capable of and all the office politics stuff. Like I think that they're going to have a tough time.
You're right. That is actually a big deal because I think a lot of the way young people advance just in general in all different types of work. It's like being there, being reliable, being in someone's face all the time, having them see you jump on grenades. Like that's how I always did it. So I think that's right. I think that's a really good point. But we want to know what you guys think. Leave us your feedback below on any of the topics that we mentioned. Be nice. Say nice things to us. If you like the show, go ahead and subscribe. Tell your friends about us. Give us a like, and we really appreciate it. We will be back next Tuesday.